And now, ladies and gentlemen, the star of our show, direct from the bar,
Pimpy.
What is going on out there, peeps? Yes. Thank you all for tuning in. Had a great show with Marie last night. You guys, look, we did a good show. Of course, you have all your trolls in here. I don't care. I love how people always go, Pimpy don't know what he's talking about. Well, which part don't know what I'm talking about? Be more specific. Pimpy's not credible. What do you mean I'm not credible? I'm the most credible person in our community. Nobody is more knowledgeable than I am. Not a single damn person out there. And I'd be willing to bet any amount of money that you guys want to lose that nobody out there is more knowledgeable than I am. So feel free to lay your money on the line because I'll be happy to take it from you. Anyways, let's get into gold as a reserve dollar. Something that Chris Marcus had a guest on that I found to be very interesting and why you should pay attention. So let's go ahead and get into this. Before we get started, do me a favor, hit the thumbs up button. If you're not a subscriber, please do so because when you do, it helps out the channel and I certainly do appreciate it. Right, taking a look at cryptocurrencies. Right now, Bitcoin's at $117,947. It's at a nice level. Ethereum's at $3,752. XRP is at $3.17. Solana is at $185.42. Dogecoin is up to 23 cents. Cardano is at 82 cents. Stellar Lumens, or XLM, is at 43 cents. Chainlink's at $18.42. Oh, look out now. Litecoin has broke the top 25 again. $114.07. Gold at the end of the week was $3,335.60 per ounce. Silver was at $38.36 per ounce. Chris Marcus had a gentleman named Luke Gromen on there, and he brings up some good things that you guys should be aware of. Not just the U.S., I believe we're looking at a worldwide change of reserve dollars, and he's going to explain why nobody else wants to be the reserve dollar, but why gold is most likely going to take over. So let's go ahead and get into this. Courtesy of Chris Marcus at Arcadia Economics. I'll leave the link for his YouTube channel down below.
You've done a great job of laying out, A, what you thought the Trump administration would have been wise to do when they came in, B, trying to unravel what it is they're actually doing, which I think often there's what they tell us and then what might be happening behind the scenes, and also explaining why you feel we're kind of getting to the point where there's some things in the way that we may be coming up against a boundary here. So maybe you could put that into perspective for people who are trying to understand all that.
Sure. So when we came into the year, I think plan A that they vocalized was, if you remember, Scott Besson said, hey, we're going to take pain and sort of undo some of the sugar high of the prior administration. And that might drive stocks down, and if that does, that should drive a bit into treasuries for safety, and that should drop low end, that should drop 10-year treasury yields. And judge us by what happens to the 10-year yield, right? They said that will be our metric. And then when that happens, and then we're going to also overlay Doge cuts with that, and that should further reduce deficits and further lower rates. And then we're going to term out the debt, and that's what we're going to do. And I remember at the time saying, as you know, like, that's not going to work. Like, it might work for a couple of weeks or a couple of days getting yields down, but ultimately all they're going to do is trigger a crisis, and it'll be a crisis where yields drop for a second and then start going up, and then you'll have this toxic, stocks down, bond yields up dynamic we've seen at times throughout this year. And then they overlaid something I didn't fully expect in terms of how they executed it in February, but flagged it very vocally, basically with the America First investment policy. They basically, in not so many words, telling China, take your money and get out of here. And so then we had this brief moment of price action that was emerging market in a sudden stop balance of payments crisis of dollar down, bonds down, stocks down. And we knew that it could not last. And ultimately, post-Liberation Day, we saw the bond market, as Trump say, got queasy. And that was sort of our base case all along, which is you had to run the proper order of operations, because with debt and deficits where they are, if you start trying to, you start pulling out Jenga blocks from the bottom of the tower is going to fall. And the tower is the treasury market. And the tower started to fall. You saw intraday volatility levels in the treasury market on par with like the collapse of Lehman and other sort of really big notable crises, and the Trump administration backed off. And had I been the perfect analyst, I probably would have written a piece that week, said buy everything, and then gone to the beach and been drinking Mai Tais ever since. And I did flag certainly that it was a big change and that we thought that could be, a major change in policy. In hindsight, it has been. But since then, it seems like they've moved towards sort of their plan B, which was really our plan A all along, which is, all right, you got to juice nominal growth and effectively start to try to anesthetize the long end of the Treasury market so that yields don't run away from you as growth comes in better than expected. And so I think we're now in a spot where, there are some things going on in some foreign bond markets that are a bit troubling in terms of UK, Japan, that could have issues for volatility. But I think on net, as I sit here today, whatever, July 23rd, I think the market's probably finished the year up from here on net because we've got, the benefit of a weaker dollar. We had the worst start to the year for the dollar since, I think, 1973. And historically, you get weak dollar. You have a lagged response in terms of better global growth, better global liquidity. So I think that will help, all else equal. I think it's underappreciated. I think we're going to have peace over the next 6 to 12 to 18 months. If for no other reason than the last 2 months have demonstrated the United States cannot go to war with a near peer or peer power without Chinese rare earths. And the Chinese, the CCP is a lot of things, but one of the things they are is, one of the things they aren't is stupid. And so they're not going to sell us the rare earths. It's like, hey, please send us military grade rare earths. And then China says, okay, great. What are you going to use them for? And America's like, we're going to use them to surround you and point weapons at you. And the Chinese are going, no. And so we can watch that conversation happening in real time. You just call up the news wires. And so I think we're going to have peace, which is good for asset prices and growth. And then I think this sort of active treasury issuance through stable coins is and the Genius Act, I think, is ultimately about trying to anesthetize the long end of the treasury market. Basically, finance more in T-bill markets at zero globally rather than in 10-year yields at 4.4%, wherever they are today. And ultimately, we know if they're successful in that, which there is some question around, we know what to do with that. We saw Yellen do it. We saw Yellen shift to the front end at the end of 23, and that was really good for stocks. It was really good for gold. It was really not great for the dollar. It was good for lots of things. And so I think when you look at weaker dollar impacts, lagged impacts, peace, and active treasury issuance to the front end via stablecoin dynamic, I think it's going to be good for stocks. I think it's going to be good for gold, and I think it's going to be good for Bitcoin. I think it's going to be good for global growth. And so, we'll see if something interrupts that. There's still obviously huge headline risk, right? When you talk about secondary sanctions on Russian oil, that's maybe one of the biggest. But I think the more likely ones, I think that's more of a black swan to me, even though they're threatening it. I actually don't think they can credibly do that. But let's see. I think the more realistic ones are bond market crises in the UK or in Japan, which would, in my opinion, those are our top two foreign creditors. So they would spill into treasury markets really fast.
Yeah, and I thought it was interesting how it was about 2 months ago, there was a Reuters article where the Japanese finance minister, they were saying, well, last month he said we're not going to use treasuries as leverage in a trade deal. Then this month he's saying we're not so sure. Sure seems like, despite Trump saying if you de-dollarize, we're going to kick you out, they're kicking out a lot of their customers when they need more of them than ever. Also, the tether and stable coins, we'll come back to that because I'm either missing something or not sure how that works. Although, Luke, you touched on the dynamics with China. I also found it interesting when you mentioned in your column that you felt China actually stepped in between the Israel and Iran truce. But along with that, obviously, there's some people who believe, well, China needs the U.S. more than we need them because who else is going to buy their things? Yet, I think that dynamic you pointed out where it's not as simple as like, hey, we can show up with our military. They're going to do what I want. So anything you could touch on there to expand on that?
Yeah, for me, it's all about, in the end, if you start breaking world trade and the existing patterns, eventually, given debt levels, everything would break, right? I think prices of everything would go to zero. if you just started breaking stuff and stood aside and did nothing to intervene. The $64,000 question is what breaks first and what do they do to respond? And my case all along had really been that China had better leverage sooner than the Americans had, which is to say, yes, do they need us? Yes, they do. Not nearly as badly as Washington was saying, though. And at any rate, I was saying very credibly that, by mid last year, it was pretty obvious to a lot of people in China that Trump was going to win. And if Trump was going to win, it stands to reason that the trade policies were coming back. And so I was hearing that a lot of exporters in China were stockpiling 6 to 12 months of cash. So right off the bat, that tells you they've got, it ain't good for them, but that's a lot of staying power, right? That's an oxygen tank. They've also been able to find a lot of replacement cars. I think I saw something the other day that they've been able to replace 85% of the lost demand from America with other customers throughout sort of Southeast Asia and elsewhere. It creates some issues there, and those will, again, that's not a permanent fix per se, but again, it's a fix much sooner than, two things in America will have a problem. Number one, the Treasury market, which we were saying all along was absolutely, to us, by far the biggest leverage point that would break first. And so we did Liberation Day, and the Treasury market just functioned in 7 trading days, and the Trump administration blinked. That was all pretty much like kind of how we thought it would go, to be honest. The other thing that people didn't pay as much attention to, they're certainly paying attention to now, is the rare earth situation. And I thought it was a big deal. And admittedly, I didn't even know how big a deal it was as I've learned more and seen the reactions. But I'm astonished that it seems like a lot of the Trump administration didn't really understand how big a card rare earths were until it was played. And it's a little bit of one of these Pandora's boxes that once you open it, you can't close it. Vis-a-vis was saying before, we're begging them to send more military rare earths, and they're just telling us no.
Yeah, I was going to say, I could have swore recently we found out in the United States we have a lot of our own rare earth minerals. Now, the thing that gets me is we found that all these properties that the United States was buying, the government, had all this stuff underneath to be mined, but they just wouldn't let us mine it. Estimated 2.34 billion metric tons of rare earth minerals discovered in the United States. Known for its natural beauty, the U.S. state of Wyoming may soon be known for something buried beneath its stunning topography. An estimated 2.3 billion metric tons of rare earth minerals, which makes the world's computing-dependent technology possible, were recently discovered near Wheatland, a town in southeastern Wyoming. According to American Rare Earths, the company's wholly owned deposits have a potential volume far greater than China's estimated 44 metric tons of minerals, which could establish the U.S. as the world's largest supplier. At present, China supplies about 95% of the global supply of rare earth minerals, 74% of which are imported by the U.S. So China has us by the cojones because you need the rare earths in order to make these missiles, and we've been getting it from China. So if indeed we do find out that we have all these rare earth minerals, then we would easily become number one in the world.
And there's not a darn thing we can do about it. What are we going to do? Go to war with them with the rare earths we don't have? Like there's nothing we can do. So the only thing we can do is sort of move to industrial policy and sort of give Defense Department more control of the economic process. And guess what we're starting to see, right? A lot of people were really surprised by that MP Materials acquisition or investment by the Pentagon. But if that surprised you, you're going to want to pace yourself because there's going to be more of those. There's going to be a lot more of those, I think. And really that one was the second one. I would argue that the Nippon Steel acquisition of United Steel, there was the golden share dynamic, right? Where we have sort of the controlling golden share still within all of that. That's like a China 101 textbook move that the Wall Street Journal was criticizing in an op-ed literally 2 years ago. So I think, strike one was that, and not even strike, but just sort of instance one of that, of more industrial policy in the United States. That was the first instance. The second was MP Materials, and I think you're going to see a lot more. Well, what does that imply? Well, if we're going to get into Chinese-like industrial policy, which I think is the right thing to do, it means that the old system is dying. It means the dollar's reserve status as it has been structured for 50 years is ending. Because the structure of the post-71 dollar reserve system, you don't get to do that. You don't get to, print money and invest into your own domestic industries. And so it's the right thing to do. And it implies, I think, really good thing. The rest of the world's going to look around and go, well, I'm running surpluses with the Americans. I'm competing with the Americans. In some cases, I'm an adversary of the Americans. And they're printing dollars and investing, essentially, it's oversimplification, but into their own industries to compete with me. Fine. Am I going to buy their treasuries? Hell no. No. What am I going to buy? But I don't want my bonds to be the reserve asset, because that means I have to hollow out my manufacturing. So the Chinese aren't going to, yuan's not going to be the new reserve currency, but the new reserve asset's going to be gold, in my opinion. And you're seeing that. Central banks are going, okay, well, makes no sense to buy treasuries from a math or geopolitical perspective, or, structural perspective with industrial policy. I can't buy Chinese. I don't want to buy the Europeans, and the Europeans don't want that anyway for the same reason the Chinese don't. The Brits, come on. Japanese, they don't want it either. So all that's left is gold, and you're seeing that. And I think that's going to continue, and that ultimately will be great for gold. I think it will continue to secularly weaken the dollar over time. I think it'll be and kind of rebalance things. But that's how I kind of see it.
Yeah, and you've given this example before that maybe you could share, because I think it puts it in perspective. If some country is an oil exporter and traditionally they would dig the oil out, if they didn't need all of it, then they convert it to treasuries. But what the problem is, and because I think, we have a gold and silver audience, so obviously for decades we've been talking about one day, yet it feels to me that we're at that point now, and you started describing it, where the treasury is, in terms of its viability to be used for the purposes it's supposed to be used for, it seems to be at or nearing that break point, and perhaps you could go through that.
Yeah, I think from a reserve standpoint, I think the break point was 11 years ago. Global central banks stopped buying treasuries on net, led by the Chinese, Russians, and others. Even now, you look around, there isn't an OPEC member or Russia in the top 15 or 20. I think in the top 15. I think Saudi's 16 or 17. And they own like 1/3 or 1/4 of what the Brits do. Right? Think about that. The Brits are a twin deficit nation. Right? So I think from an FX reserve standpoint, we reached the breaking point on treasuries 11 years ago. And it led to this sort of weird time where people like China were going around taking their surplus dollars and buying up really valuable assets on the cheap. Oil fields, farmland, ports, copper mines, gold mines. You Google China buys over the last 15 years, you can just see them going around on a shopping spree. And the American government was sort of asleep at the switch because they were dogmatic. Like, well, the king dollar, and we need to keep this system. And, we started, well, they're breaking the rules-based global order. Well, maybe the Chinese would say, well, when you printed money to get out of 2008, you broke the rules-based global order. So I'm not an idiot. I'm not going to hold your paper, if you're going to print money to get out of every crisis. That's stupid. I'm not stupid. So they started putting it in stuff that'll go up when they print money to get out of crises. But that started to defund the U.S. government. And so we've seen this sort of secular rise in interest rates. Paradoxically, a secular rise in the dollar began in 2014, right? You went from 70 to 70, 71, maybe 74 in the DXY. It's risen to as high as 114, back to 97 or something today. But ultimately, that was, I think, triggered by a couple different things, but ultimately the weaponization of the dollar. When you put repeated sanctions on important economic players and you print money to get out of crises, you can't use that as your reserve asset anymore. And for the same reasons I highlighted before, like the only asset that can take its place is gold. And I think things were clearly moving that direction. The 2022 sanctions on Russian FX reserves, I think, turbocharged that. And I think the Chinese de-dollarization of their commodity markets have also turbocharged that over time. And so you get to a spot where you look back 15 or 11 years, global central bank holdings of treasuries is down $200 billion, and their holdings of gold's up $800 billion, both at market prices. So I think that process is underway, and then there's sort of fits and starts within that, because paradoxically it leads to a stronger dollar and higher rates that, given the structure of the system, that leads to, crises that require more dollar, liquidity to be injected, et cetera. But that's ultimately simply I think these are the things we're moving through on that front. And you can see as it relates to oil, right? Oil has gone from 8 barrels an ounce of gold in 2008 to 60 barrels in 2024 earlier this year, 60 barrels an ounce. And I think when you talk about this shift away from treasuries and sovereign debt more broadly as reserve assets, what you're really, given that most of the world's surpluses and deficits tend to be generated around energy, what you're talking about essentially is increasingly oil and commodities bidding for gold. And the oil and commodity markets are a multiple of the gold markets in physical terms only. And so, I think 8 barrels an ounce to 60 barrels an ounce over 15 years or 17 years, I think is sort of the first entree. It's the first chapter, or maybe the first couple innings. But I think ultimately we're going to get to a world where, gold trades at 100, 200, 300 barrels of oil per ounce. And I don't think oil is going down a whole lot, because the biggest 90% of the growth of marginal supply over the last 10 years has come from shale, and shale doesn't work much below 60. So I think most of that gold to oil ratio going to 100 or 200 or 300 over time is going to be on the price of gold.
I'll leave a link for the full video down below in the description, and I'll also leave a link to Chris Marcus's channel, Arcadia Economics, so you guys can go ahead and go over there and check it out. Gold as a reserve in exchange for oil. Very interesting. 100, 200, 300 times. Nothing below 60. He's talking about $18,000 an ounce for gold. Now, keep in mind, for those of you that have silver, the poor man's gold, silver never stays far behind gold. As gold goes up, so does silver. So even though gold might shoot up, don't panic. It's better for you to buy silver, because you could buy more ounces of silver than you can gold, and you still can catch that ride. Anyways, I thought it was interesting that this gentleman was talking about that, and I just wanted to share with you gold as a reserve currency. Let me know what you think down below. I look forward to hearing from you. I'm out.